Dark pools of liquidity. Pool, an electronic venue or mechanism that accumulates non-displayed liquidity and provides matches of bids and offers. A dark pool can take the form of an alternative trading system, internalize order flow, or exchange reserve hidden orders, and is designed to minimize costs and market impact while preserving client anonymity. One of the main advantages for institutional investors in using dark pools is for buying or selling large blocks of securities without showing their hand to others and thus avoiding market impact, as neither the size of the trade nor the identity are revealed until some time after the trade is finalized. Dark pools have been around since trading began. It's not new, it was just called upstairs trading in the past. What is significant in the recent years is the volume traded. Why do investors use these dark trading facilities? The primary purpose of dark pools, and dark orders more generally, is to minimize market impact. By restricting access to undesired market participants, such as high-frequency trading firms, and by not revealing quotes, dark pools enable institutional investors to minimize their information leakage and realize more efficient executions. More specifically, dark pools of liquidity facilities provide the possibility of price improvement and reduced transaction costs by crossing orders at the midpoint of the quoted best bid and offer prices, thereby saving on both the bid-offer spread and on exchange fees. For these reasons, dark pools have been popular for the execution of large block orders. Three major types of dark pools exist. Are dark pools required? Algorithmic trading: the use of computer-driven algorithms to execute financial transactions in the marketplace. The process is designed to be highly automated, with minimal need for manual intervention. Algorithmic trading is popularly used in the equity markets, but it is also found in the foreign exchange and commodities markets. Alternative Trading System, ATS, an electronic venue that serves as an alternative to a traditional exchange, providing trading services by matching buyers and sellers directly, without the use of a broker or dealer. High-frequency trading, HFT, is a type of algorithmic trading characterized by high speeds, high turnover rates, and high order-to-trade ratios that leverages high-frequency financial data and electronic trading tools. While there is no single definition of HFT, among its key attributes are highly sophisticated algorithms, co-location, and very short-term investment horizons. Previous estimates reporting that HFT accounted for 73% of all U.S. equity trading volume in 2016. Dark pools are highly regulated. All dark pools are broker-dealers registered with the SEC and the Financial Industry Regulatory Authority, FINRA, and subject to regular audits and examinations, similar to an exchange.
To many people, this is what trading on the stock market looks like. These traders are buying and selling stocks on the floor of the New York Stock Exchange. But the introduction of algorithm and computer-powered trading has changed how and where investors go about their business, going from physical spaces to virtual ones, like the NASDAQ. In recent years, another subcategory has emerged, a way of trading stocks that is completely shut off from public exchanges. Dark pools. A dark pool is a private electronic platform where investors trade shares privately, away from more transparent stock exchanges. Some dark pools only allow investors to trade large chunks of stocks. Others are open to smaller transactions. Here's how they work. First, investors place orders to buy or sell stocks into the dark pool. Then the dark pool computer system electronically matches buyers and sellers to fill the order. Dark pools allow firms to buy and sell stocks secretly, without alerting the broader market to the orders until after the trades are completed. They were originally created to protect institutional investors Not just big outfits handling portfolios of the rich, but money managers who handle 401ks totaling billions of dollars. In recent years, fleet-footed trading firms such as high-frequency traders have started dabbling in dark pools too. So let's create an example. Take this fund manager, we'll call him Mr. Smith, who handles a huge pension fund. In that pension fund, there are 1 million shares of Company X. He wants to make a profit on these shares and decides to sell them all. Now, imagine Mr. Smith doing this trade on a public stock exchange. Since he doesn't want to cause a major move in the market that could affect the share price, he starts selling small slices of his order at a time, say 1,000 shares per trade. But even so, eventually the sophisticated algorithms that firms use to detect big trades begin to pick up the pattern, and so traders start lowering the price they'll pay for the shares of Company X. Suddenly, Mr. Smith is selling for a lower price than he'd hoped for. Let's re-envision the scenario. He may try to avoid what happened at a stock exchange by using a dark pool. Here in the dark, no one knows what orders have been placed, and no information on the transactions is disclosed until after the trade has taken place. The dark pool computer system simply matches buyers with sellers as best as it can. So if Mr. Smith makes his transactions inside a dark pool, he might get a fairer price on those 1 million shares than if he sold them on an open exchange. Dark pools started to proliferate in the early 2000s as Wall Street trading desks, hedge fund managers, and high-frequency traders started using sophisticated computer systems to trade billions of shares a day. Trading on the open exchanges was like playing high-stakes poker, with all your cards on the table. So growing numbers of investors fled for cover in dark pools. More than 50 exist today, and they account for more than 10% of all stock trading volume in the US. That's up from 4% in 2005. One of the big worries regulators have about dark pools is that they are, well, dark. People have little idea about what goes on in them, and as a result, they are concerned that investors may not always get the best deals when they use them. Still, with more firms using algorithms to sniff out large orders in the open market, one thing is clear as day. Dark pools are here to stay.